Welcome back, everybody, to the 4-Star, today's Market Explained podcast. And what a month it has been. This is the second podcast of June. It's the 17th of June. It's my son's 30th birthday today. You know you're old when your son is 30. I'm Brian Castle. I'm your host, and I guess I'm old. And I'm here with Mr. Chris Reardon, my co-host. Chris, welcome.
Thanks, Brian. Good afternoon, everyone, and glad to be on.
And Chris is the Director of Development, Master of all things portfolio. He's a new dad, and he also still loves his Cleveland Indians. Chris, glad you're here with me today again. It's been a great run. Thank you. And then I'm Brian Castle, CEO and founder of 4-Star Wealth, Chief Investment Officer of the 4-Star portfolio programs, in which we have the 4-Star protection plan. We'll talk a little bit about that today and how that's worked. And then also, I'm the father of Evan and Quinn and husband to the amazing Tripty. So why don't we get started here, Chris? A crazy couple of days last week, a crazy couple of weeks. Markets crashing again here. So let's talk about it, Chris. What does the market look like? What about the tally scores between all the different asset classes, like we do on all our market reviews?
Yep. Yeah. So to give you guys a frame of reference, the last, I think, review we had really was beginning of June. So from there, we still have commodities holding the number one position. Actually gained 4 points from the last check-in. So that was, I guess, positive to a degree. I think a lot of that was oil was driving that. Cash moved into the number two position. So that's the biggest change. It gained 21 points. It firmed up to 187. It bumped above both domestic equities and international equities to take that number two position. Domestic equities was the big one that fell. It lost 30 points. It moved to 169 from the last podcast. International equities fell 21 points to 163. In fourth position, fixed income is in fifth position. It gained 9 points to 149. And currencies is still in last, but it gained 19 points and finally broke above 100. It's at 105 now. So a big change up. I don't think it would necessarily surprise a lot of people. Obviously, like you said, Brian, markets have been very volatile the last week. You could even some say the last month. It's been a volatile market, but change ups.
So all the way down to currencies, right?
Yep, all the way down to currency. Yeah. Currencies in sixth at 105, 19 points. I mean, and that'll be interesting. I think what we could see is potentially domestic equities drop to 4. So we could see 1 commodities, 2 cash, 3 international equities. That's certainly a possibility. And, currencies is moving up in fixed income. So there could be continued shakeup over the next couple of weeks as well.
Absolutely. Well, it's a sad situation, and markets really seem to be rolling over here. And we were going along in an orderly fashion where the Fed announced they were going to do 50 basis point increases every month for the next 3 or 4 months, somewhat undefined there. But nonetheless, it was going to be a regular program. Then the market understood that. Then things got worse. Thursday, the GDP number came out worse. Consumer spending number came out worse. Housing numbers came out worse, and all of a sudden the market completely collapsed Friday. The follow through on Monday, always at the open, there's a follow through, but then it got worse and worse and worse. So the markets closed near the bottom on Monday as well. So we were down almost 7 to 8% on all the indexes over a 2-day period of time. Then there was a 2-day rally or a morning rally in the S&P, but then on Tuesday the S&P closed down again. So we had a major collapse in the market over a 3-day period of time. Then a rally on Wednesday, small. And of course, then a Thursday, big time move down again. So the market's retesting the lows of Monday. We'll see if they hold. But I would say that's Yahoo Finance had phrased that as the 4 days that changed the Fed. The markets were speaking, we don't believe this. It's going lower. So now instead of 50 basis points, Chris, they did 75, right?
Yeah, 75 basis point or 0.75% move. That came out Wednesday, and that's the largest increase since 1994. That was the last time they did. as big of an increase as that. And I think it was an interesting reaction the market had. If you guys caught what Brian said, Wednesday was actually a rally. So the markets originally kind of rallied off of this 75 bip move. I think maybe happy that the Fed was taking it seriously, inflation seriously, and they were really trying to, get it under control. But then overnight, the market soured again, and Thursday was another brutal day down. So it was a short-lived rally there on Wednesday.
Yeah. And so anyway, Chris, and Switzerland for the first time raised rates, first time since 2007. So we know it's a significant thing with inflation. So it is around the world, and the administration is saying that it is around the world. But to say that inflation is everywhere, not in every country. So there are countries that are not in as bad a shape as the U.S. inflation. UK has also raised rates, I think 4 times now, 25 basis points each, but they're talking about accelerating their movement. So there's a worldwide inflation phenomena because of oil prices, and then some food prices. Food and energy are the 2 big ones.
Yeah, well, and the European Union in particular is being impacted by Russia's war on Ukraine. I know recently Russia came out and slashed their gas exports again to Europe, driving up energy across. I think over there, they're averaging about $10 a gallon for gas. So they're feeling the inflation more from that front. In the U.S., it's other factors, I think, that are contributing to the inflation here.
For sure. Well, and then also Bitcoin, which was always considered to be an anti kind of a safe haven of choice recently, and that's gone now below 20,000 for the first time in 5 years. The average buyer of Bitcoin is now underwater because most people bought Bitcoin. Last year, we came up with a statistic that 55% of the owners of Bitcoin had just bought it in the last year. Well, that was all above 20,000. So most people, the average buyer, is now underwater in Bitcoin. And I remember the days when it was under 1,000 a unit back in 2017. So very interesting development, right?
Yeah, and I think it topped out with around 64,000. So obviously a big fall from grace there. I think what's interesting from that perspective, what I've seen is you're seeing a lot of lawsuits come out in regards to crypto right now as well. There's been such heavy losses and significant losses that people are going to some of these exchanges and even celebrities that kind of endorse certain cryptocurrencies or made statements on behalf of them and are getting sued by certain people. So I can't speak to the legitimacy of them, but it's interesting. We're probably going to see a lot of this flying around because, I mean, billions of dollars was lost. People who invested money in this cryptocurrency and got kind of caught up in the frenzy of it.
The hype of it all, yeah. But some crypto experts are saying this is actually a good time to buy. And it's really kind of anyone's guess, to be frank with you. But Chris, you have a bunch of economic numbers that you want to review. Let's hear those.
Yep. Yeah. So, I think the first thing I'll mention is the U.S. inflation number. And this was the primary driver behind the interest rate move, the 75 basis point interest rate move. It came in at 8.6% in May, which was the highest rate since December of 1981. Before that, I don't think a 0.75% rate increase was on the Fed's table for the most part. But that was the main contributor, I think, for them going so big on that rate increase. The biggest contributor to that was energy prices. They rose 34.6%. So a huge jump there. The producer price index also rose seasonally adjusted 0.8% in May from the prior month. And that's up from a 0.4% number in April. So that pretty much doubled relatively. And I think what that tells us is that inflation, for the most part, is, at least in the short term, here to stay. We really want to see that producer price index start to steady and move downwards, because the producer price index, you think of it as more of the inputs, right? So if they continue to experience inflation, they're going to pass it on to the end consumer. Then another thing, in a poll of about 750 CEOs, more than 60% of them stated they expect a recession in their region in the next 12 to 18 months. So we're starting to see this, and I think, Brian, you had mentioned, or we talked briefly, that we're starting to see companies, I think, brace really for a potential recession, or what they're kind of foreseeing as a recession in the next year, if not sooner. Wouldn't you say, Brian?
Yes, yeah, for sure. It seems like the recession could be on right now. Actually, the Atlanta Fed went down to a 0%. For the second quarter estimate, and the second quarter still has 2 weeks left. So we'll see, but it almost feels like it's even worse than that. So, but if it is technically a negative quarter, it may not be a huge negative quarter. The first quarter was negative, so 2 quarters in a row is considered to be a recession. But to this point, it will have been mild. But we'll see then what the third and the fourth quarter brings as rates continue to rise. And Federal Reserve and other central banks continue to raise rates. And what that will do, they need to get rid of inflation. Inflation in this way is really bad. So they've got to deal with that. And the tools to solve inflation could easily sink the American economy into a deeper recession than more of a mild recession, which it seems to be right now. So,
yeah. I mean, I think that's being felt really. I mean, retail sales, which is a number adjusted or seasonally adjusted, they fell 0.3% in May from April. And the sharpest drop of that retail sales number was vehicles. So vehicles and housing, I think, is what people mostly correlate to interest rates, because most people borrow to purchase these assets. And we're seeing massive drop-offs in those vehicle purchases. So overall, kind of the goal of the Fed, right, though, but it's slowly going to kind of choke off several parts of the economy. Yep. And then the last thing we're seeing really is mortgage rates. So mortgage rates hit 5.78% after the 0.75 or 0.75% rate hike. So 5.78 is the highest level since 2008. So obviously that's going to have a big impact. We're already seeing signs of the housing market starting to slow, and that'll only continue. And that's probably healthy. That's one of the objectives. Another objective of the Fed is to kind of start to slow down that market. Some of the impacts we're seeing on this: initial jobless claims increased 27,000 to 229,000 in the first full week of June. That still isn't a big number. And I would expect, we don't know for sure, but I expect to see that to start to increase a little bit more and accelerate towards the end of June and July, as these CEOs you talked about and companies kind of brace for what they see coming. So I would expect that jobless claim to start to tick up a little bit more. And that's kind of what I see.
All right, Chris. Well, great. Well, thanks. There's also some interesting things going on with company guidance. So everything was going along just fine, but then Target cut guidance, which companies will definitely do. So they lower the estimate of earnings that they need to achieve for the quarter. So that's kind of an admission that things are slower. But then 3 weeks later, they did it again. So that's retail, and retail is really tough. To see companies do a guidance change and then within a month do another guidance change lower is really quite sharp. We haven't seen that but once or twice in our career. And then Microsoft cut guidance on currency issues, and then they did it again a couple of weeks later. So there's another company, a third company, Intel. These are all big cap companies, cut guidance from forecast 6 weeks earlier that they had also cut. So we're seeing some really interesting things that haven't seen before. So that means something is changing very, very fast. Now, compared to 2020, when we plunged ourselves into a very deep recession because we shut down our economy. And if anyone remembers back then, the third quarter of 2020 was down 32% in GDP. That's a record number. That was actually caused by the pandemic and actually our forcible shutdown of our economy. So this is a little bit different because everyone knew that would recover and bounce back, and it has for the most part. But now we don't have some things that were present in 2020. 2020, we had the PPP program and all the other stimulus programs that were out there. Americans were getting checks. In fact, some of it caused the inflation, Chris, like we were talking about. But at least that kept, even though the economy shut down, it came right back because the money was there. And the federal government, unfortunately, went into big debt to do that. The Fed increased their balance sheet as well. So we always said in varying podcasts, what does it look like when the Fed spends almost $12 trillion of either federal spending or balance sheet enhancement from the Fed? What does that do to the economy? Well, now we know. Now we know it causes massive inflation. Okay, we're not quite back economically to where we were before the pandemic, but now it's going the opposite way. So we never quite made it all the way back. And this time we don't have the stimulus programs. So now we'll see what the economy is going to recess to without all those PPP programs, Chris. All that money out there. Some of it's still around, right? But there's no new money flowing in. And we'll see what happens.
Yeah, it begs an interesting question of, would we have been better off if we did not inject all that money into the economy? I think it's going to be interesting. I mean, this is something people are going to study. It's crazy to think about, study decades from now. But what would have been the best move? Because we're feeling the pain now. We certainly kind of helped ease it a little bit back then. But you can't inject all that money and have it go nowhere. So at some point we were going to have to do this, and we were going to have to feel that pain. And that's kind of led to where we are right now, for the most part.
Well, and clearly the public is reacting to it. The president's poll numbers are now the worst of any American president in modern history, and going lower. Actually, seems like every day there's another poll, another report that comes out, and they're not being honest about some of the solutions. And in the background, from my connections in Congress, in the Senate, they're still trying to talk to Senator Joe Manchin, the Democrat from West Virginia, to try to get their buy-in for another spending package for Build Back Better. So most economists will come out and say that the overspending and the overstimulus is causing the inflation. So if you're actually looking for more spending, they must have decided they're not going to get inflation down, or maybe they can blame the Fed for the inflation. So the Fed's now trying to solve it by raising interest rates, but their solution is more money. And that says to me probably more votes, since we're coming into an election season. So maybe there's a chance they keep some of those votes if they create a program that gives people money and they remember it was President Biden that did it. So that's all I can think of, Chris. I can't. The strategy doesn't make any sense to me. That's all I can imagine trying to do.
There is actually a political theory behind that. Of they'd rather have the higher inflation because that gets spread, as weird as it sounds, spread amongst everyone. Than what we're going to see now, most likely, which is a slowing economy and slowing job market, because people getting fired, it feels a lot more personal than inflation, which is everyone's kind of bearing. So that certainly could be. That certainly would line up, I think, with that political theory of what potentially they're trying to do, which will be interesting.
Well, and the blame game has started, of course. We've seen that now for a number of months. For the first couple of months of this huge inflation spike, we've seen the president and the administration officials talk about how it was the Putin price hike. And Vladimir Putin was blamed for everything. Now, much of that inflation was happening for almost a year, accelerating before Putin started the war. So that's not really a credible argument. But in the short run, has the Putin war started an additional round of increases? Yeah, a little bit. There's been some there. But to say that it's really the Putin responsible wasn't very credible. So as a result of that, the administration has now changed their tune. And this week, President Biden was jawboning and challenging the oil companies to produce more oil. Now, for his entire administration, he's been shutting down leases, shut down the Keystone XL pipeline. We have less supply in America. We were independent for energy. Now we're not independent anymore. And the president's going overseas to our enemies to try to get them to send us more oil. Now we're negotiating with our enemies instead of having our own oil industry in America. So now the oil companies are the bad people. Please drill more please get more oil out onto the market, the administration says, but you're making too big a profit, so you're gouging people. Well, that's not really true either. It's the market that's doing it. So now the oil companies are to be blamed, Chris. I think they're moving on from Putin.
Yeah, I mean, I think that the oil companies, could they drill more? And we've talked about this a little bit here. They have investors. They have their profit margins look out, and they're going to look 10 years out in the future. And I think with the way this administration and in a lot of ways the country, to a degree, really wants to push EV cars and push certain other objectives, I see the writing on the wall. I think one of the funny things is we're going and trying to negotiate from the whether it's the Saudis or these overseas markets. They have to then ship the oil here, which is in turn eating up more of this oil because ships don't run on electricity. So it's almost like this self-perpetuating cycle that we're having. The other thing I'll mention that doesn't really get talked about a lot is not only if we did have a huge explosion in oil drilling happen, the U.S. has shut down a lot of refineries due to stricter regulations on the refineries and just demand not being there. So even if we were to drill a ton, have this huge input of oil come online, you still have to plug it through this bottleneck of refining to get it to gasoline. So I feel like this has been really what we've seen for the most part from this administration, is this really simple tack to try to simplify something to as something so as, oh, they're just greedy oil companies, when in reality the actual problem is infinitely more complex.
It is. And we have a self-inflicted wound. We're favoring terrorist states that hate us for our oil purchases instead of doing that oil here in our country. And, the ideal of having clean electric cars, and that's not perfect either, by the way, is so important to certain ideologues that are part of the party of the administration, that they are saying even, that they don't need any more oil. Karine Jean-Pierre says yesterday, we don't need more drilling in America, that we're going to be just fine. We'll get oil elsewhere and that kind of thing. So that's just crazy thinking. It just doesn't seem like they have a handle on it. They want electric vehicles so badly that they will plunge the American economy into a recession and hurt the pocketbooks of literally tens of millions of working class and middle class Americans, who are the ones that get hurt the most. I filled up my vehicle this morning. I've never paid more than $100 for a full tank of gas. I paid $111 for a full tank of gas today. And that's not fun. I can afford it. A lot of people can't afford it. And, that's who is really getting hurt, is the middle class and the working class people. They can't afford that. They can't come out and say, no problem, I'll pay double what it costs to go to work every day. I don't think so.
Well, and I think that we've mentioned this. I think overall, electric cars, I bet, are probably where we are going eventually. But the technology is not there. Most people can't afford an electric car. They don't have $80,000 to buy a new, electric vehicle, and they can't afford to charge it or the capacity. So it's trying to force technology that isn't there on a population that A, can't afford it, you can't bear it. I mean, these transitions take 50 to 100 years, and it, once again, probably is the future. They're more efficient, but we're just not there from the technology standpoint yet.
It needs to be more gradual, and they're moving way too fast.
Exactly.
Really damaging the country.
They're trying to push it in 5 years.
Yes. Well, and Chris, we've talked about this many times. Recessions happen, in my view, when the Fed tools no longer work. And that's what happened in 2008. They had a bunch of stimulus, but the economy really cratered for a year there. And then it finally came back. Or recessions happen when the Fed tools are tools they cannot use. Like in this case, they would want to keep liquidity out there, but now because of inflation, they're required to raise rates. So that raising of the rates is probably going to cause inflation to come down, but it's also then going to spill the economy into a worse recession. So that they can't, keep free, cheap money out there, keep the economy going. So as the interest rates rise, it'll ward off inflation, but also hurt the growth in the economy. So this is the kind of that dichotomy that the Fed has to deal with. And so it's not a good situation. We'll see how far this economy falls. Markets are signaling that they don't like it. Now, the markets sometimes have signaled recessions before they've happened, and sometimes they've never happened. Like 1987, there was no recession. 1991, there was a big market pullback. In 1990, and there was only a mild recession. So sometimes the markets overreact, but it does appear that we're going into a recession right now by all the metrics that we're seeing right now. So, Chris, in the what we see out there section, you had some good news on electric vehicles.
Yeah, talking about electric vehicles. So Ferrari has finally started to throw their hat into the electric vehicle ring. They promised a vehicle by 2025. And they're going to start looking at incorporating EV more into their cars as they move forward. So that'll be interesting. I mean, I think from a performance standpoint, like I had mentioned before, electric vehicles, because as soon as you put the pedal down, it's instantaneous power. And that's why the ridiculous numbers you get out of some of these Tesla cars that go from 0 to 60 in like 2 seconds. So it's going to be really cool, I think, and interesting to see what Ferrari does with it. The concepts are cool, and I think, like I said, that the EV from a standpoint of power and efficiency is definitely much greater than a general vehicle and a motor and the cylinders. I mean, all those things that lose efficiency. So, and then the last thing I'll mention is that China has finally started to kind of awaken out of the slumber, if you will, although Shanghai is still under heavily strict controls. I think they even said weekly, I think they plan on testing the entire city of Shanghai weekly, which is mind-boggling to me. But so we're starting to see them stir a little bit, which is okay, or pretty good for the global markets. We did see, I think, a little bit of pop from the international front here and there. But it'll be interesting to see kind of what that looks, a month or two from now that they finally have awoken from about a month and a half that they were just pretty much completely shut down.
Yes. Well, it's interesting. They have a very different way of doing it, and that could never, with the freedoms in America, that could happen here, Chris. I'll tell you that. And actually, the power and control of the dictatorial societies like China and some of the other communist societies around the world, they have control and they can do things, but that's also part of the reason why they're so acquisitive. And now China is rattling the cage about Taiwan after Russia went into Ukraine. China is threatening everyone, don't interrupt us if we go into Taiwan. No one defend Taiwan. And those societies, because they don't have real growth, because they don't give people real freedom to make decisions, they're required to do acquisitions, which is how wars start. And they try to take over other countries, and that's how they gain and how they grow, because they can't grow normally internally that well. Because they don't allow their citizens freedom. For democracy and capitalism, for capitalism to work, we need freedom and freedom of choice, individual actors all making individual decisions, and they make them for the best reasons possible. That's not always the case in a communist society, and that's why those countries need to keep doing acquisitions, essentially, by taking over other countries when their political will is there, and that's what Putin's doing in Ukraine. That's what China's trying to do in Taiwan as well. So, it's interesting. China, has a avowed interest in taking over the world, being the leading economy in the world, and even taking over America at some point. So we have to be very, very careful about that and keep our own sovereignty. So,
yep. Yeah, I would say I think the positive aspect of that is I think the U.S. from the military aspects and everything is very aware of that. So I think they've said that China is the biggest threat, I think, to American democracy over the next century.
No doubt. And Chris, you mentioned Ford Motor also is building electric vehicle plants in Ohio, I think, Michigan and Alabama.
I think Alabama.
Right.
So Alabama or Mississippi in the South. Yeah. I mean, we're starting to see businesses reinvest, I think, in the American markets, because of the supply chain issues that plagued us in the past. I think what we'll see is companies try to at least bring a portion, if not all, of their capacity home here. So if something were to happen like 2020 again, we wouldn't have this complete logjam in the supply chain that is still causing issues, right?
Yeah, for sure. Well, also out there, we see, Chris, that Revlon, the famous cosmetics company, is filing for bankruptcy. The market seems to have moved on somewhat from Revlon. Famous Ron Perlman, who's controlled Revlon for decades now. But now this morning, there's a possible buyout of Revlon. So it might end up being a brand in another large cosmetics company headquartered outside the US, unfortunately. The Elon Musk saga continues with Twitter. Elon met with the employees of Twitter, talked about how no longer are people going to work remote. Basically, get back into the office or give me your resignation, is what he said. And so he's being real clear on that one. Then also talking about potential layoffs and efficiencies. So he's challenging all the Twitter employees to be more efficient in everything they do. And, certainly Elon Musk has been a great creator of value and a capitalist leader. So maybe he'll turn things around. Twitter hadn't made money in years. So maybe it's time for Twitter to not only be a free speech tool and not be limiting people's conversations, but also make money at doing it. Elon Musk said he wants 1 billion users, and he thinks he can get it. So that'll be interesting. And then 2 sad stories. Russia is planning for default because the oil markets are all roiled up. They're not getting much for their grains because their grain markets are all destroyed by their own war with Ukraine. Between Ukraine and Russia, we've taken about 20% of the grain markets out of circulation. So that's why we've seen grains galloping up, and we've had grain positions, Chris, in our portfolios as well. And, because prices keep going up. So that's not good. So Russia's going to have to plan for defaulting on some of their debt, but I'm not sure why anyone would buy Russian debt anyway, or Chinese debt. I'm not quite sure how that makes any sense, but some people have apparently done it. And then the last one I wanted to mention is Japan. Through all their demographic issues and from years and years of overspending, they have the largest percentage of GDP of debt of any nation in the world. Japan is close to collapse. So there's been various incursions by different European and our own country as well to try and help support the Japanese economy. But it looks like it might just collapse. They may have a debt crisis where they'll have to restructure their debt, basically default. And Chris, we've talked about in the podcast a number of times that there's not been a single currency in world history that's lasted as long as the US dollar. And I think dollar was formed in the late 1700s, I should say. So it's not quite the full history of America. We operated on the Articles of Confederation originally, and then we got the Constitution. But now the American dollar is also at risk because we're adding record levels of debt. We're not quite Japan-like, but we've added 15 trillion in debt in just about 10 years. That is an unsustainable rate. If we don't stop it, we will be like Japan or some other South American nation like Argentina that had a huge debt crisis. Could that happen here? Sure, it could. We're human beings, and debt is debt. And if you have people that control you and own your debt and you can't pay your debts, then you have a problem. And so we're getting rapidly to that point. So let's hope that our leaders figure out how to stop operating with heavy debts from here, because we don't want to end up like Japan. Right?
Yep. Yeah. Get a little bit more responsible. I think that I'm hoping it gets brought to the forefront a little bit more now. But, we'll see. I mean, I feel like the way politics and government and everything has played out, it almost seems like it doesn't matter to them anymore, which is pretty crazy. And I think it's one of those sad things that if we keep it up, it's going to seem like nothing until it's already here. It's going to seem like, oh, what's the big deal, until we already have a problem and we're kind of already dug ourselves out of a hole we can't get out of.
Yes. Well, and then Japan had the additional issue that they're aging and their birth rate is down. So the society is getting older and older and older. And that is not a recipe for carrying heavy debts because the government can't pay it. The nation doesn't have as much tax revenue coming in to pay for it. So we could get into that situation in America as well. So whenever you carry heavy indebtedness, you then put yourself at risk for a lot of other unintended situations like a demographic issue or some other need that you need to put that on, like in a worldwide emergency or something like that. And we are not really prepared anymore to do that. If we were before the pandemic, we added a lot of debt during the pandemic. We either need to pay it down or not add and grow the economy so it becomes a less and less percentage that we can handle the debt. So we'll see where that happens. But anyway, that's a much longer issue. We just wanted to bring that up today. But the last final item I wanted to bring up was an item of good news. They've seen less brawling on airplanes because now the masks were lifted by a federal court. The Biden administration wanted to keep the masks on, and the court demanded that they release that the federal government administration did not have the power to put masks on in an airplane any longer. There's no longer an emergency. So now there's less fighting that are going on in airplanes. A lot of it had to do with all the personal incursions on our rights, and people were very, very upset. So I've been on a lot of planes lately, and it does seem to be a lot milder, a lot cooler. Everyone seems to be getting along. There's a lot of tension when there were masks. So there are a lot of rules, a lot of people telling you how it is or what to do or what to say. And a lot of people just don't like that. So that's good news. That's almost a real big positive here for the summer. So Chris, let me just recap. Since our last podcast, we had a blog post on the Leadership Matrix at fourstarwealth.com or the leadershipmatrix.blog of an update on rates and home sales. So interest rates have gone up. So home sales have really slowed down quite sharply, although home prices haven't gone down because we still have a big supply problem and there's less and less supply in the market. So could we see an environment where home sales slow down, but home prices stay up? Sure. Depending on how things go on, the supply curve is still shifted way back. That's what happened during the pandemic, and it's still that way now. So that could also lead to a strong home building cycle once we get through this short-term downturn in the economy. So that's an interesting update on the 4-Star Wealth Leadership Matrix blog. And then also, we talked about the movie markets coming back, and we talked about this, I think, a little bit the last podcast. People are going back to movies. I've been to a few movies recently myself. Movie theaters are full. Everyone's going back to movies. And even in the Depression, that was one of the places that was always still very vibrant was the theater and the movie scene in America. So that's back. But there are shortages in popcorn and popcorn bowls and all the things that you might serve at a theater. So there's still some pandemic effects to the movie industry. So there's a popcorn shortage out there in America. So popcorn prices are going up. Also, we did some interesting interviews. Those are also on the 4-Star site and also available in Stitcher, Spotify, Apple iTunes under the 4-Star Wealth Today's Market Explained. We did AJ Osborne, who is a specialist in self-storage investing. So we introduced that concept to our investing clients. And then also we had Bill Shopoff and Bill Ocean, Shopoff Realty, talk about the real estate markets. They're heavily in California real estate, and they're very positive on the future. There's a supply-based issue where there's plenty of demand for real estate. Maybe not in the commercial market as much, but certainly in the housing market. And so they see good things coming for real estate. And of course, in the 2008-2009 decline, we saw the real estate markets collapsing because we were in the middle of a real estate bear market. But now we're not really seeing that as much anymore. And the real estate markets are often a alternative market of choice for people that are tired of their stocks going down. So they'll sell their stocks and then they'll do other things with the money, and they could do real estate. That was always like another asset class that, didn't go down as much as the stock market when the stock market was going down. So that might be a phenomenon that's happening again. We're no longer in a real estate bear market. Maybe we're going to have a little bit of a pullback in activity and maybe prices, but maybe not, depending on the supply issues. Nonetheless, real estate could be okay here. So it's going to be really interesting to see how this plays out. We've never had a pandemic like we went through. We've never had a recovery from the pandemic like we went through. Now we're in the aftermath after the recovery. So these are all kind of new things. And so we're still trying to figure it all out, Chris, aren't we?
That's very true. There's a lot of unknowns still out there, but we'll just get update by update and try to keep you guys as updated as we can.
Well, and then for those investors with 4-star, many of our clients are involved in what we call the 4-star protection plan. I'll just recap that one more time, that we have models that raise cash a maximum level in 4 different moves, 2 portfolios that go to 50% cash and 2 that go to 100% cash under the right conditions. A dynamic model, however, picked up the commodity rally, and so that side of the portfolio is invested where the stock part is all cash. And as Chris mentioned, cash is now ranked number 2. Commodities are ranked number 1. So we have a couple of portfolios that are up on the year, even though the market's down 23% on the S&P and 32% on the NASDAQ. We've got some portfolios that are up, and many of the other portfolios are heavy cash and down in single digits. So while no one's happy at all being down, many investors have been hurt dramatically here. Pure tech investors could be down as much as 40% year to date, with the indexes down 30. So it's a time of very stressful feelings about the markets, but we do have a protection plan that can help investors. So if you want to talk about that, let us know. And Chris, why don't we leave it there, huh?
Sounds good.
We're done for the day. June 17th, the year of our Lord 2022. And thanks everybody for being with us. And watch again for another great episode of the 4-Star Today's Market Explained podcast. We've got a couple of great interviews coming up, and in about 2 weeks, we'll be back with another update on what we've seen in the economy since this episode today. Thanks for being with us, everybody. Bye-bye now.